Hello everyone. I wanted to start this channel for a while now, mainly focusing on macro and investment ideas. I thought the best would be to kick off with a macro outlook base regarding to the changing world order we've been hearing in the past couple of years. So let's just jump right into it. So I think there are a couple major themes going on, and this would be a general overview of today's presentation. What comes to mind looking at these trends, right? So you have an uncertainty and time horizon axis here. You can see that some are more immediate than others and some are more certain than others. So for example, let's start with aging population. It's a fact of today. In many countries, especially famous are Japan, Germany, and Italy. But globally, it's been a trend of basically a depopulation, aging societies, and the changing preferences, resource allocations, and everything that comes with that. So that's pretty certain to happen. It's already here, no questions about it, and its time horizon is here. Next one is, I think, which is more politically sensitive in today's day and age after the Trump election, is the topic of globalization, how that would look like. I would put the time horizon close. We could argue we are already seeing ripples of the Trump effect. Uncertainty is high, especially with Trump in office. We know that one day the tariff is in, the next day it's out, or it's delayed, or it's changed. So it's certainly a top theme. You can see equity valuations, and I would specifically mention US equity valuations today. It's very uncertain where they can go. The time horizon, I would say, is now or near-term future. How that will play out, we'll touch upon that later. I don't want to spoil it or anything. We also have a debt problem globally, partly due to our monetary system being debt-based. So new money is created when mostly commercial banks issue money, when they create credit on debitors' account. I think in the UK, around 94% of new money is created by commercial banks, and it's approximately there for most countries today. Increasing health costs are coming with the aging population, right? So with prices rising in the health industry and healthcare and insurance, you will see more resources being allocated there, and that's just a fact of this shifting demand. A 20-year-old want something different than a 65 or a 75-year-old. You will also see today the G7 and BRICS divide. I would say most of that is mainly like a theater or politics, but definitely you can see the rise of the BRICS nations. But I would argue against categorizing the BRICS as a unanimous whole entity, because they have all sorts of different agendas and all sorts of conflicts of interest. And then the last topic would be the US dollar dominance for today. You hear today the BRICS currency, or I would say you've been hearing that for a while now, the BRICS currency, gold as returning as a global medium of exchange. And we will see about that. I think money is misunderstood in today's day, and gold could not compete what the dollar can do actually. But let's touch upon that later. So regarding the aging population, I've got some stats here. So in the next decades, population aging will accelerate, pressuring the working age group and raising pension costs. So if you look at the OECD populations, which are aging rapidly, you can see the number of people over 65 per 100 working age people. You can see in the 50s, you basically had not many pensioners compared to today. And then you see the growth rate on the chart. It's actually going to accelerate in the next 40 years drastically. What does that mean? That means you have a different demographic shift. You will have different demands, you have different growth rates, savings rate, everything's going to be impacted by this, and it's not a surprise to anyone. You can also see that, for example, in countries like Japan in the past, it's a great example, maybe China today, but Japan certainly in the past, you had the so-called economic the so-called demographic dividend, which means that you have basically no people to take care of, really. So you have a small portion of the population as kids and a small portion as pensioners, and you have a huge working age population that can boost rapid economic growth. That happened for Japan, maybe that happened in China now, and then you and Japan and China in the future, you will see kind of a reverse of that you don't, because you didn't have kids in the past, now you have no adults actually to work relative to each other. So you can see the OECD pension spending versus the average life expectancy after pension. So it's not just that you have more pensioners in the system, but people are actually spending more years in pension. So when pension was famously, I mean, it was the invention of Bismarck, and then people, and in the US it was FDR who kind of introduced the system, the social security system. But at the beginning, a small percentage of the people got actually to enjoy the social security system, and they spent relatively few years. Now fast forward today, you can see in the OECD numbers that it was 16 years in 1980, and today it's 21 years spent in pension. And then you can see a rise also in pension spending relative to GDP. It's not a surprise. You have the increasing health costs. So demand is shifting towards more health spending. Do not mistake it for inflation. Inflation is a completely different story, and people like to mix it with just rising prices. Can the inefficient public sector handle this, or it's an opportunity for privatization? So I think that's a great argument regarding to privatization, and there is going to be a political debate about that going forward. The argument could be that the government is really inefficient and the private sector could do it better. You can see some of that already today, especially in the US with Musk's Doge, to not specifically to pension, but to highlight the government inefficiencies versus the private sector. And it's mainly due to the lack of feedback mechanism for the government actually relative to the private sector. So you can see just general health spending to GDP numbers in some countries. You can see Portugal, Spain rising, Brazil rising, and China rising, but they are not as drastic. I think that's actually interesting for China. People would think they are higher on the list, but not yet. You see also the euro area health inflation versus inflation. Health inflation was outpacing basic inflation until recently, when you had the post-COVID huge expansion of the money supply causing inflation, and paralleled with lockdowns and the throttled supply chain. So that's like you have more money chasing fewer goods actually, and then it spiked up. But I would say health inflation should outpace inflation in the inflation as people use it, price increases. I really like this chart. So it's regarding the debt problem. To tackle high debt, you can either increase taxes and cut spending, which is politically really difficult to do, or default on the debt. You can do a hard default, or you can inflate the debt away as a soft default. So I would argue that, as Milton Friedman said, government taxes or borrowing always crowds out private consumption. So the more government you get, the less productive the economy will be, less growth. That's I would like to just put it out there. We are looking here at the US's history. You can see on the green is the real returns on US government bonds. I picked the 10-year. The blue line shows the delinquency rates on business loans. And then you have the US debt to GDP on the red. So the story here is, if you have really high real rates, then you probably will have high business loan defaults, just because it's higher real rates. It's much harder to pay it back. And at the time in the late 1886, you can see that the US government debt was 48%. You had relatively really high real rates in the US, right? It was just after the great inflation of the 70s, Volcker hikes, everything. And then you had a high real rate paired with high business loan defaults. And then you fast forward today, you see the progression as rates were coming down. inflation was coming down, but the real rates, which actually matters, was coming down steadily, and the US debt was rising parallel. So you can see the average real return on US bonds between 87 to 2005 was 3.8%. That's a nice real rate for basically no risk. And 2006 to 2024, you basically get zero if you just use the 10-year government minus the CPI, and then we could argue how valid the CPI is. So if you probably adjust the CPI to something more rational number, you would be below zero, I'm sure. You can see that in 2022, during the high CPI print, the real return on US government bonds really collapsed, and that's basically inflating away your debt. So I think that's something people should be more cautious about. Governments struggling with their finances can somehow fix. How can they fix it? It's really hard to cut spending. Look at France trying to not just cut spending on pensions, but reform pensions, maybe push out the age. It's really hard. You lose elections, you get protests. If you default, well, that's not really an option, is it? Except if you're Argentina. Or you can inflate away the debt, right? So many countries today would probably follow the inflate the debt away. And many countries actually in the 2008 crisis who had debt issues, since then they learned from it. So I have a good example in Hungary. They had a large foreign debt problem, which is an issue, right? If you're not indebted in your own currency, and they were really in a problem. Today they are more indebted in their local currency, which helps them to actually inflate that debt away. And who holds that debt? Well, yeah, the public and institutions. So you have to be careful to maneuver this. Also balance it with the outlook of risk today. So it's not that all government bonds are bad for investments, but you have to be mindful and cautious. High US equity valuations. So the US overspends by borrowing while the world sells and invests their dollars into US assets, driving up their prices. What happens if this shifts? So first I saw this argument from Double Line Capital, and it really resonated with me. So if you look at the United States international investment position on the left, you can basically see US liabilities to the world and US assets, US owned assets of the world. And then you see this gap. It started in early 2000s in the 3 trillion-ish area, and today it's minus 26 trillion. So what does that mean? That every time like you see a large negative balance of trade of the US, how do you plug the gap? Well, what do you do if you're Chinese or Japanese exporting to the US? You have a lot of dollars at hand. You invest it. Where do you invest it? Well, you can buy up African mines, and you can do all sorts of things, because the US dollar, more specifically the euro dollar, is the global currency of the global market. But you can invest it in the US. So that means the larger the balance deficit, the more dollars flow abroad, the more dollars actually come back, pushing up asset prices in the US, buying stocks, buying bonds, buying agency, mortgage-backed securities, all sorts of things. So that was helping the US markets since the early 2000s, that having a steady inflow, $26 trillion accumulated, coming into US markets. And then you can clearly see the parallel between the increase of the net, and on the right side you can see US versus global ex-US equities. You can see the early 2000s, both charts starts in 98. You see the dot-com era, and then you see valuations on the right chart. So dot-com era was just below average valuations actually. And then you see relative to that 2007-8, on the left chart you see that actually net investment flows to the US were dropping slightly or staying flat in 2007-8, and then you see on the right that relative to foreign stocks, the US didn't really perform. They went down one standard deviation from the average. But after that, wow, you see a huge net inflow into the US, and then you see huge US outperformance against every major market actually across the world. and then now you are like 2 standard deviations, about more than 2 standard deviations above the average, and you see the May drop in the US coming back up. It's a really interesting dynamic. I would be really cautious holding US equities at this point. There can be an argument made, but I'll talk about on the next slide that. Exactly. So US equity valuations. US equities are priced higher than historical norms, warranting caution due to elevated risks stemming from overvaluation. I'm sure you're familiar with the Shiller PE ratio. If not, please visit the website and just Google Shiller PE and you will find it. So this is cyclically adjusted, which means that price to earnings ratio is based on an average inflation adjusted earnings from the previous 10 years, known as a cyclically adjusted PE. You can see that the S&P had like a 17 PE-ish mean. There is like a minimum point below 5 PE in 1920, because 1920, 21 see a quick depression. There is actually a great book called The Forgotten Depression of 1920 and 21. I suggest you read it. It was following the World War I huge inflation, monetary expansion in the US. And then you have the 1929 peak, just below 33 Ps. And then you fast forward to, and you can also see the 60s, the 1966 valuation up, 1981 valuation down. You can look at really good charts of gold versus Dow Jones or gold versus S&P. You see a similar pattern. You see the dot-com craze of 44. That was the historical peak. And today we are sitting just below 37. So on the previous slide, I said you can look at it a bit different. So it's not just like, if you look at it like this, it's overpriced. But you can make the argument that people say this time is different. Well, actually, sometimes this time is actually different, maybe 20% of this time. That's what Howard Marks said in his recent memo I listened to from Oaktree Capital, is that sometimes it can be actually different. So what could make this situation different? So you could make the argument that in the past, let's say before the 90s, you had mostly capital-heavy industrial companies, less growth, more debt. So they were different industries. As today you look at the industrial companies, you look at cyclical companies, energy companies, they have generally way more assets, fixed assets. They have lower growth, they have lower scalability. So they have these structural things. In today, if you look at the S&P, it's not mining companies and energy companies. It's mostly tech companies, software companies, banks. Maybe banks are actually not a good example, but tech companies which have really capital light business models, scalability globally, they have huge growth potential. So it's different. You could make the argument that the mean today maybe should be 22, 23, 24, 25 even. But 37 is definitely a really high rate, which implies a 3%-ish return on the S&P. So I would be cautious, especially if you can buy a 10-year US bond yielding more than 4 or 4. So that would be my take on the valuations. It's really high, but you can adjust for the different type of stocks that are in the indexes. And actually the index is mainly led by the top 7, the Magnificent 7. So it's all the other stocks are not as highly valued as those, and they are bringing the index up. High US equity valuation. So the market runs into trouble when it forgets that over the long term, corporate earnings grow at only about 7%. As previously discussed, maybe today it could be 9%, 8% because of the tech, maybe 10% because of the tech exposure. But the story would be here is this is an inflation adjusted S&P. The story here would be that people like to say that stocks only go up. Well, tell that to somebody who was holding the Nikkei in 1990. I think they maybe broke even, but that's like 30 years. So it's stocks not actually always just go up, especially if you adjust them for inflation. So you can see previous peaks here. You can see 1906, electricity coming in, new tech, so that it's also repays the newness of the bubbles are extreme. You see that if you bought the peak in 1906, you broke even in 22 years, 11 with dividends in 1928, inflation adjusted. You can see the same thing appear again. If you bought the 1929 peak, you took 27 years, actually 22 with dividends, until 1956 to break even, right? 1966 peak, right? Took 26 years or 16 until 1992. So those are like huge periods you are missing out on. And you have these like 70%, 80%, minus 62, minus 59%. So these peaks are crushing for a long-term investor if you buy really expensive. So a good company may be a good investment, maybe not, because it has to also have a good price attached to it. Next up, I would like to talk about the US dollar dominance. The US dollar is set to remain the global reserve currency due to its widespread acceptance, economic stability, and liquidity, with no viable alternative. So the US dollar serves as a global medium of exchange, facilitated through banks, through the euro-dollar system. It's really efficient. It works. Actually, it's been kind of broken since 2008, but it's still much better than anything else. There are no viable alternative to replace it. You see the share of foreign exchange transactions. Most of it is in US dollars. So if you're a Swedish company trying to buy something from a Japanese company, what do? You exchange into US dollar most of the time. You buy US dollar, and then the Japanese company will exchange its US dollar back to yen at home. So that's what you use it. And the euro dollar system facilitates this with their system. You see share of export invoicing mostly in US dollars. You see the euro up because within Europe, the countries trade with each other mostly in euros. You see the share of global foreign reserves are held also in US dollars. Similar reasons really tied to the euro dollar system. If you're, let's say, you're a Japanese company, you have a bank, and that bank has a dollar shortage need, then you can give it short-term funding help. So you need the dollar in all of this. And all the story about the US government deficits are really high. Yeah, it's true. Its debt is rising. Yeah, it's true. It's still much better. And then you have demand, especially today. Everybody is talking about the US debt will go up in interest rates. The bond prices will collapse. Well, I would argue against that because it's still a safe haven asset. And when you have a slowdown in the global economy, rates come down, bond prices go up. So you can also see the US dollar since 2000. Rivals have a limited ability to challenge the dollar in the near future, while the dollar's share of global reserves is on a decline. Its lost share has been distributed among multiple currencies. So you can see that from 71 to 58, the dollar dropped. What does that mean? Well, we could also make the argument here that the 71 was unnaturally high. So it was just 10 years after the collapse of the collapse of the Soviet Union. You have a global hegemon, unipolar world order. So, of course, the dollar is going to be central to the whole system, with all of its institutions globally, the IMF, the World Trade Organization, and so on. You see the euro there. Of course, Europe uses the euro. Many non-euro European countries also use the euro heavily. You see the yuan, the Chinese yuan coming up, the Japanese yen flat, the British pound a bit up, and other currencies actually gain. But the dollar is still there, and it is just the reserves, so it makes sense. And then recently, the US dollar has weakened against currencies of major developed countries, yet remains stubbornly strong against others. So I piled together two indexes. One is in red, the Dixie index. The Dixie index is usually what people call the dollar index. On the top left, you can see the Dixie basket composition. It's mainly the euro, the yen, the pound, the Canadian dollar, and these major currencies. So it's euro yen heavy. So it's developed market heavy. On the other index, in green, you see the trade weighted broad dollar index I got from the Federal Reserve's website. This is based on trade volumes. The picture is different, right? You see the euro, the Chinese yuan, the Canadian dollar, the Mexican peso, the Korean and the Taiwanese currencies. You see these diverge. So the dollar is down, yes, but compared to their trend, and we could look at like maybe a 30-year trend or 20-year trend, the dollar is still really strong. And it mainly weakened actually against the euro. I will probably have a video on that later. So I would argue that the dollar is far from being replaced by BRICS or gold or any other currency or system as of now. And the dollar is still really, really strong, especially for non-developed major countries. I mean, just look at Argentina and recently with their collapse of the peso again. It's not nice. Maybe we can see a new IMF bailout in Argentina. Of course, because of their political situation of Milei losing a major area in the recent vote turnaround. Politically not stable. So his reforms with these election results, I questioned if the next government would be his, or maybe they go back to the old regime and methods of doing things. So you see the G7 versus the BRICS nations. So the growth of the BRICS nations shifted the global power balance. You can see on the left debt to GDP. Both G7 and the BRICS had an increase in debt to GDP, but you can see a higher growth rate and a higher debt level actually for developed countries, which is concerning. On the right, you can see a GDP adjusted for purchasing price parity for G7 versus the BRICS. And in 2020, actually, the BRICS overtook the G7 if adjusted for purchasing power parity, and then they have more than double the growth rate. So I would say that's still because the BRICS started from a much lower base compared to the G7 on the one hand. On the second hand, of course, they have way more people. So just the GDP purchasing price parity is one thing, but if you would look at the per capita base, it's a whole other story. They are not even close. But it's a radical rise, and it does shift the global power balance, as we can see on the next slide. So you see the G7 versus BRICS. Actually, you see the US versus China. So in 2001, the US was the largest trading partner for most of the world. Today, that role belongs to China. And that is, in a picture, the shift in power balance, right? So let's talk about globalization. So globalization's first rise and fall. Trade surged with empires collapsed with wars and protectionism, and recovered post-World War II through free trade. So we learned it in university that free trade is beneficial. It's a win-win for everybody. If you are doing something more efficient than I do, a certain product, then you do your stuff, I do mine, and we trade and we both benefit. Some people today don't think that works. So you can see the foundations really of globalization. So steamships, railroads, telegraphs, lower trade costs, everything leads to lower trade costs. Britain leads, global networks begin. So with Britain's rise and rule of the seas, it was getting, the foundations were getting built. So the first great globalization boom happened in 1870 to 1914. Why there? You had the Franco-Prussian War. You had stability before World War One. You had that was the German-French situation sorted out for the time being, of course. You had Central Eastern Europe kind of sorted out after the 1848 revolutions. You had Austria-Hungary kind of coming to terms with each other as equal partners that stabilized and all of that. So you had the Germans forced the French to pay their reparations in gold. They switched to the gold standard. Most countries switched or had the gold standard in the developed world. So trade surges with tech innovation, open markets, and the gold standard. So massive migration, capital flows, and empire-driven trade. So you had actually a huge migration at the time, different than we have today. So you had a lot of European going to the US and expanding that vast continent. 1913 is the peak globalization at the time, just before World War One, and then you obviously have a collapse. So you have the 1914 to 1945 gap. So on the chart you see that World War One, the Great Depression, and World War Two devastate trade, right? World War One, of course, in the 20s you had kind of a rebound, as you can see in the chart, but then you have the Great Depression stopping everything, right? And between the two wars, especially after the 29 issue collapse, you have this rise. Actually, after 29, you have this rise in protectionism, right? So I'm sure with Trump you heard about the Smoot-Hawley tariffs. Ad valum tariffs added to European goods, and then Europe retaliates, and then you have a breakdown of trade. There is a nice saying, when goods stop crossing borders, soldiers will. And then you have the dirty floats, the currency blocks. So everything is anti-trade, protectionist, and tensions rise. So trade falls to levels not seen since the 1800s. And then you have a recovery. 1945 to 1969. You have post-World War II rebuilding under US leadership. You have GATT, which is the predecessor of WTO, which reuses tariffs, pushes for free trade. You have, well, at least under US leadership, you have like the UK used to be. In a certain sense, you can use the oceans, you can trade, you have financial systems set up, you have international organizations facilitating this, and the banking system facilitating this. So that's a really, really crucial part of the global banking system. The euro-dollar system starts, well, I would say 52, but in the 50s in London with offshore dollars, but that's too much detail for this video, I would say. From global trade expansion to rising protectionism, the future of globalization will balance interdependence with resilience in a more fragmented world. So you can see end of Bretton Woods, right? So with 44 summer, you have Bretton Woods getting discussed, implemented. The dollar is tied to gold. Every currency is tied to the dollar at a fixed exchange rate with a limited leeway. In 71 August 15, that ends. Nixon takes the US off the gold standard. Let's not go into it why. And then 73, you have the first oil shock. The late 70s, you see neoliberal policies getting introduced in the US through Reagan, mostly in the 80s. And you can see actually that with Margaret Thatcher in the UK, and it sweeps across the modern world. You see financial market deregulation. You see the fall of the Berlin Wall. You see economic liberalization in India, the fall of the USSR. So 94, you have NAFTA in North America. 95, you have the WTO. Then you have a crisis in 97, in Asian financial crisis and reforms, which can be argued how financial crisis that was, but definitely caused a lot of reforms. China joins the WTO in 2001 December, and then you have the 2000s boom period, the global credit boom, which culminates in the great financial crisis in 2008. and then globalization, second golden age, kind of stops. I mean, it flatlines. So we are in the era of globalization. 2010s, you see nationalism and rising populism, challenging globalization. You see Brexit, you see Trump. 2012, you see the Eurozone crisis. What about Greece? What about Italy? What about Ireland? Those kind of issues. You see 2016, as I said, Brexit in the UK, which happened in 2020, but voted in 2016. With the first Trump presidency, you see the US-China trade war kind of kicking off. Then you see 2020, COVID, lockdowns, supply chain issues, bottlenecks. That ties in with the resilience and the resilience there. So Trump's China trade sort of touches on resilience, sure, but interdependence is a great argument. If you interdepend with China, can you go to war with China? No, probably not. But survival always beats prosperity. So in the end, resilience will win interdependence, because interdependence is sort of also wealth. So you can get richer if everybody has traits, but that exposes you. So you are not as resilient. You see 2022, Russia-Ukraine conflict in February. You see US-China tech wars during the Biden administration. And now you have Trump in office. And now you have all these tariffs and trade issues coming back up. So it's a struggle between wealth, so interdependence and trade, versus resilience, nationalism, protectionism. Survival always beats wealth, but maybe this time it can balance back up. But you see the rise of the shifting global power, US losing its dominance, which was actually not natural, because most of the world was underdeveloped and the developed parts were destroyed by 2 world wars. So you had everything for yourself, which is changing now. And that would be it. And thank you for watching. Please leave any comments you think are useful, any questions you have, and any suggestions of future videos. I was thinking to start the next video to talk about some investment and stock ideas I have, and some research which could be a great fit for this global outlook on the macro and new world order style, and sometimes adding another macro take, FX or interest rates. So with that, thank you, and have a nice day. Take care.